$38 trillion. That's where U.S. national debt stands right now. Not projected, not theoretical. Actual obligations on the books today. And if that number feels abstract, like something that belongs in spreadsheets and congressional hearings rather than your daily life, you need to listen carefully. Because while most people were arguing online, scrolling headlines, and assuming tomorrow will look like yesterday, the largest financial institutions on Earth started repositioning capital on a scale not seen in generations. This isn't rumor. It isn't speculation. It isn't internet fear content. It's visible in public filings, capital flow data, and portfolio disclosures that almost no one reads because they're boring, dense, and inconvenient. Trillions of dollars are being quietly shifted away from concentrated exposure to the United States. Not announced, not debated, just executed. Slowly at first, then with increasing speed. By the end of this series, you'll understand exactly what's happening, why it's happening now, and what usually follows when this process reaches its final stage. Because this isn't a new story. It's a very old one, and it follows a pattern so consistent that once you see it, you can't unsee it. Global debt recently crossed $250 trillion, according to IMF data. That's more than 3 times the size of the entire world economy. In the United States alone, debt has accelerated at a pace that would have been considered unthinkable just a decade ago. But debt itself isn't the real signal. Debt is the background condition. The real signal is what the smartest capital in the world does in response. And that response has already begun. Every major financial turning point in modern history follows the same basic sequence. It doesn't matter whether the dominant power was Spain, the Dutch Republic, Britain, or later the United States. The names change, the technologies change, the political slogans change, the pattern does not. First comes the ascent. A nation becomes the center of global finance, its currency becomes trusted, capital floods in, innovation accelerates, trade expands, asset prices rise steadily, confidence becomes absolute. The system feels permanent. Then comes overextension. Success removes restraint, spending expands faster than productivity, debt grows faster than income, military commitments multiply, social promises compound. Asset prices keep rising, masking the imbalance underneath. Central banks smooth volatility. The public feels wealthier even as the foundation weakens. Then comes the most important phase, the one almost everyone misses, the quiet rotation. This is when institutions with long time horizons begin reducing exposure. Not because collapse is imminent, but because risk is no longer compensated. Capital doesn't panic, it reallocates. Exposure is trimmed here. Diversification increases there. New jurisdictions receive incremental flows. Old ones receive just a little less. No headlines, no press conferences, no urgency. Until suddenly, the shift is undeniable. Only after this phase completes does the final stage arrive. Currency stress, asset repricing, political reaction. And the question everyone asks afterward is always the same. How did we not see this coming? History answers that question very clearly. The signs were always visible. They were just ignored. In the 1500s, Spain controlled more wealth than any empire before it. Silver and gold poured in from the Americas. The Spanish currency became the standard for international trade. Capital flowed toward Madrid. Spain looked unstoppable. Then spending exploded. Wars across Europe. A global military footprint. Bureaucracy that consumed enormous resources. Debt piled up, but it didn't matter because treasure kept arriving. Asset prices rose. Confidence remained high. Until major banking families began moving assets out of Spain. Quietly, first to Genoa, then to Amsterdam. Credit terms tightened, interest rates spiked, defaults followed. The empire collapsed faster than anyone believed possible. The money didn't disappear, it moved north. The Dutch Republic became the next center of global finance. Amsterdam dominated trade. Dutch banks financed the world. Their currency became the reserve. Capital flooded in, innovation exploded. The system looked invincible. Then came overextension, wars, debt, speculation, asset bubbles. Institutions quietly hollowed out to fund government obligations. On paper, everything looked stable. Behind the scenes, it wasn't. Banking families relocated, merchants shifted operations, capital rotated toward London. Years later, the collapse arrived. The pattern repeated. Britain followed the same arc. 2 centuries of dominance, a global empire, the pound as the world's reserve currency. Then war, debt, and overextension. Capital began moving elsewhere long before the pound officially lost its status. By the time the crisis was visible to the public, the outcome was already decided. 3 empires, same sequence, same result. This matters because the United States has now entered the same historical phase that preceded every prior transition. Not collapse tomorrow, not panic next week, but rotation. Foreign central banks have been reducing U.S. Treasury exposure for years, some slowly, some more aggressively. Trade settlements increasingly bypass the dollar. Alternative payment systems expand quietly. None of this is dramatic on its own. Together, it forms a signal. At the same time, large asset managers are adjusting portfolios, not abandoning the US, but no longer treating it as the unquestioned center of global allocation. Exposure is spread across regions. Infrastructure, commodities, and non-dollar assets take a larger role. Concentration risk is reduced. This is exactly what has happened every time before. And here's the critical point. This phase does not reverse because of speeches, elections, or optimism. It reverses only if the underlying mathematics change. Debt trajectories, demographics, productivity, fiscal discipline. So far, they haven't. That doesn't mean disaster is imminent. It means the window for preparation exists. Historically, this phase lasts longer than people expect, and then ends faster than they imagine. In the next section, we'll look at how this rotation actually shows up in modern financial systems, what capital is moving toward, and why institutions act years before the public narrative catches up. Because once you understand that, you stop reacting emotionally and start thinking structurally. This isn't about fear, it's about recognizing the cycle while there's still time to respond. This is where most people misunderstand what's happening. They expect capital flight to look dramatic, sudden crashes, panic selling, a visible stampede. But historically, the most important moves happen quietly, years before any crisis becomes obvious. The public reacts at the end. Institutions act near the beginning. Large asset managers don't operate on emotion. They operate on probabilities, correlations, and risk-adjusted returns. When a system becomes more fragile, they don't wait for confirmation in headlines. They reduce concentration. They widen exposure. They prepare for outcomes that are statistically unlikely in any single year, but increasingly likely over a full cycle. This is exactly what's happening now. Over the past several years, U.S. assets have remained dominant, but their share of incremental global capital has begun to decline. Not collapse, decline. That distinction matters. The dollar is still widely used. U.S. markets are still deep and liquid. But they are no longer treated as the only game in town. This is the first structural shift. At the same time, capital is flowing into areas that benefit from a more fragmented global system. Physical infrastructure, energy logistics, commodity production, real assets that generate cash flows independent of financial engineering. These aren't short-term trades. They are long-duration positions, designed to function under multiple monetary regimes. When institutions with trillions under management start prioritizing resilience over maximum yield, it tells you something important about how they see the future. Consider how reserve managers behave. Central banks are not hedge funds. They don't chase performance. Their mandate is stability. For decades, stability meant U.S. treasuries, deep markets, predictable settlement, political trust. But stability is relative. As debt grows faster than output, stability becomes conditional. As interest costs consume a larger share of government revenue, policy flexibility shrinks. As geopolitical competition intensifies, financial systems become tools, not neutral infrastructure. This changes how risk is priced. Foreign central banks don't need to abandon U.S. assets entirely for the system to change. They only need to reduce marginal demand. And that's what the data shows. Holdings peak, then plateau, then slowly decline. Each reduction is small. The cumulative effect is not. This is where the mathematics matter. A system built on continuous external demand becomes fragile when that demand softens. New issuance must be absorbed somewhere. If foreign buyers step back, domestic buyers must step forward. Pension funds, banks, central banks themselves. This creates circular financing loops that work until they don't. None of this produces immediate crisis. It produces pressure. Pressure on interest rates, pressure on currency stability, pressure on policymakers forced to choose between growth and credibility. Historically, this is when narratives begin to diverge from reality. Officials emphasize strength, media focuses on short-term indicators, markets oscillate between confidence and concern. Underneath it all, capital keeps moving. This phase can last years, but once it begins, it rarely reverses. One reason is psychology. Institutions are not required to be optimistic. They are required to survive. When risk increases, even slightly, the rational response is diversification. No single decision changes the system. Millions of small decisions do. Another reason is path dependence. Once alternative systems are built, they don't disappear. Payment networks, trade corridors, settlement mechanisms, each reduces reliance on the old center. Each makes the next reduction easier. This is how reserve systems evolve, not through declarations, but through redundancy. It's important to understand what this does not mean. It does not mean the dollar vanishes. It does not mean U.S. markets become irrelevant. It does not mean collapse happens on a fixed date. It means the structure becomes less forgiving. In a highly forgiving system, mistakes can be absorbed. Debt can grow without consequence. Imbalances can persist. In a less forgiving system, errors compound. Shocks propagate faster. Recovery requires more sacrifice. This is why the quiet rotation phase is so critical. It's the last stage where outcomes are still malleable. Once confidence breaks publicly, choices narrow. Every historical example shows the same sequence. First, smart money diversifies, then policy reacts, then the public notices. By the time the final stage arrives, positioning matters more than prediction. Right now, we are still early enough that positioning is possible. But that window does not stay open indefinitely. The most dangerous misconception is believing that strength prevents transition. Spain was strong, the Dutch were innovative, Britain was dominant, power delays recognition. It does not stop arithmetic. Financial systems don't fail because people stop believing in them. They fail because obligations outgrow capacity. That's why institutional behavior matters more than rhetoric. When asset managers with global mandates reduce exposure to any single jurisdiction, they are not making a political statement. They are acknowledging uncertainty. When they increase exposure to assets that exist outside the financial system, they are not predicting collapse. They are hedging outcomes. This distinction is subtle but critical. Most individuals never see this phase clearly because it doesn't feel urgent. Markets still function. Salaries still arrive. Prices fluctuate, but life goes on. That's exactly why it's dangerous. The quiet rotation phase feels normal, until it doesn't. In the next section, we'll examine the specific mechanisms that turn slow rotation into rapid repricing, and why once those mechanisms engage, response time collapses. This is where history stops being academic and starts becoming operational, understanding that transition is the difference between reacting to events and anticipating them. Slow rotations don't stay slow forever. They accelerate when a system's internal buffers thin out, when small stresses begin interacting instead of canceling each other. This is the moment most people misread, because nothing dramatic happens at first. The signals remain technical. Yields tick higher. Liquidity thins at the margins. Volatility appears in places that used to be boring. This is not panic, it's friction. Every financial system relies on frictionless assumptions, that buyers will always appear, that refinancing will always be available, that markets will absorb issuance without demanding higher compensation. When those assumptions weaken, even slightly, the entire structure becomes more sensitive to shocks. In reserve currency systems, the key buffer is demand for government debt. As long as demand is abundant, deficits can expand without visible consequence. Rates remain manageable. Currency pressure stays contained. Policy flexibility persists. But when demand becomes conditional, everything changes. Conditional demand doesn't disappear, it hesitates. Buyers ask for higher yields, they shorten maturities, they prefer optionality. These behaviors are rational responses to uncertainty, but collectively, they raise the cost of maintaining the system. This is where acceleration begins. Higher rates increase debt servicing costs. Rising servicing costs expand deficits. Larger deficits require more issuance. More issuance tests demand. The feedback loop tightens. At first, this process looks manageable. Policymakers describe it as normalization. Markets frame it as adjustment. But the math doesn't care about language. As interest consumes a larger share of government revenue, choices narrow. Spending cuts become politically painful. Tax increases become economically destabilizing. Monetary accommodation becomes tempting. Historically, this is when central banks step in. They don't announce rescue. They adjust policy tools. Balance sheets expand or contract. Liquidity facilities appear with technical names. Forward guidance reassures markets. For a time, it works, but each intervention reduces future flexibility. Once central banks become dominant buyers, price discovery weakens. Markets function, but signals distort. Asset prices stabilize even as fundamentals deteriorate. This creates the illusion of control. Illusions are dangerous. They delay adaptation. The next phase is triggered not by a single event, but by convergence. Several stresses align at once: a geopolitical shock, a fiscal standoff, a credit event in a peripheral market. Individually, each is manageable. Together, they overwhelm buffers. This is when slow rotation becomes rapid repricing. Liquidity evaporates where it's needed most. Assets that were assumed to be independent suddenly move together. Correlations spike. Diversification fails when it's needed most. This is not theoretical. It has happened repeatedly. In every prior transition, the final acceleration followed the same script. First, yields rose. Then currencies weakened. Then policymakers intervened. Then confidence cracked. Confidence is not belief. It is expectation. When participants expect stability, they behave in ways that create it. When they expect instability, behavior amplifies risk. The switch happens quickly. This is why timing matters less than preparation. No one rings a bell announcing the shift from rotation to repricing. By the time headlines change tone, positioning opportunities are gone. This is also where individual exposure becomes relevant. Most people are concentrated without realizing it. Income earned in one currency, savings held in domestic accounts, retirement assets tied to domestic markets, housing wealth anchored to local credit conditions. This works beautifully during stability. It becomes fragile during transition. In past cycles, the middle class suffered not because they made reckless decisions, but because they assumed continuity. They trusted that institutions would manage outcomes smoothly. They believed adjustment would be gradual. Sometimes it was, until it wasn't. Once repricing begins, the system demands sacrifice. Purchasing power erodes. Asset values fluctuate violently. Access to credit tightens. Risk tolerance collapses. Those with flexibility adapt. Those without absorb the cost. This is why institutional behavior is so instructive. Large asset managers don't predict exact outcomes. They prepare for distributions of outcomes. They accept lower returns in exchange for resilience. When that trade-off becomes attractive, it signals a shift in the underlying environment. Notice what is emphasized during this phase. Cash flow over speculation, assets tied to physical reality, jurisdictions with predictable rules, optionality over leverage. These preferences are not ideological, they are mathematical. The danger for individuals is mistaking this phase for noise. Markets still function. Indices still trade. Life still feels normal. But beneath the surface, the system's tolerance for error shrinks. A smaller mistake produces a larger consequence. This is also the phase where narratives grow louder. Optimists point to innovation. Pessimists warn of collapse. Both miss the point. The system doesn't need to collapse to impose costs. A prolonged period of instability can quietly erode living standards without a single dramatic moment. Inflation that outpaces wages, asset values that fail to recover in real terms, opportunities that narrow. Historically, this is how most people experience transitions, not as catastrophe, but as stagnation punctuated by shocks. Understanding this reframes the conversation. The question is not whether a single crisis will occur. The question is how resilient you are across multiple outcomes. That's why preparation during the rotation phase matters so much. Once repricing begins, choices are constrained. Options that were available earlier disappear. We are not yet at the final stage, but the mechanisms that lead there are already in motion. In the next section, we'll examine what typically happens when these pressures force policy responses, and why those responses often accelerate the very dynamics they're meant to contain. This is the point where good intentions collide with hard limits, and history becomes very unforgiving. When pressure finally forces policy to respond, the response is rarely neutral. It reflects incentives, constraints, and the political environment of the moment. History shows that these responses tend to calm markets briefly while worsening the underlying imbalance, not because decision makers are careless, but because the set of available choices has already narrowed. At this stage, policymakers face a dilemma that looks technical but is deeply structural. They can prioritize price stability, which requires tighter financial conditions, slower growth, invisible pain, or they can prioritize system stability, which requires accommodation, liquidity support, and acceptance of currency dilution. Both paths carry costs. Neither resolves the root problem. In earlier phases, modest tightening can restore balance. In later phases, tightening risks breaking the system. That's why policy pivots become more frequent as cycles mature. Rates rise, something strains, rates fall, liquidity is withdrawn, stress appears, liquidity returns. Each reversal sends a signal. The signal is not reassurance, it's fragility. Markets learn quickly. Participants begin to expect intervention. Risk-taking becomes asymmetric. Upside is privatized, downside is socialized. This dynamic inflates asset prices beyond fundamentals while embedding moral hazard into the system. For a time, this appears to work. Volatility subsides, credit flows resume, headlines declare resilience. But the cost is cumulative. Currency purchasing power erodes slowly, then faster. Savers are penalized, asset owners are rewarded, inequality widens, social trust frays. This pattern is not unique to any country or ideology. It is a mechanical outcome of late-stage financial systems. Eventually, the policy response itself becomes the catalyst. Once markets believe that inflation will be tolerated to preserve stability, expectations adjust. Wage demands rise. Pricing behavior changes. Contracts shorten. Long-term planning becomes difficult. This is when inflation stops being a temporary shock and becomes embedded. At the same time, higher inflation raises nominal rates, increasing debt service costs. Governments issue more debt to cover those costs. Central banks absorb more issuance to maintain order. The loop tightens. This is not hyperinflation. It is erosion. Erosion is more politically survivable, which is why it is often chosen. But erosion compounds quietly. Meanwhile, international confidence responds not to speeches, but to outcomes. If currency stability weakens, foreign holders adjust exposure. If capital controls are discussed, they accelerate diversification. If policy becomes unpredictable, alternatives gain appeal. This is how reserve status is lost in practice. Not revoked, but bypassed. Trade begins settling in multiple currencies. Financing shifts to regional hubs. New payment infrastructure reduces friction. Each step reduces dependency on the old system. None of this requires coordination. It emerges organically from incentives. The domestic impact is uneven. Some sectors benefit. Exporters gain competitiveness. Asset owners see nominal values rise. Others lose. Wage earners struggle to keep up. Fixed income savers fall behind. Trust in institutions erodes. Political responses intensify. Blame is assigned. Short-term fixes are prioritized. Long-term discipline becomes harder to maintain. This feedback loop is self-reinforcing. As polarization increases, policy coherence declines. As coherence declines, uncertainty rises. As uncertainty rises, capital seeks safety elsewhere. This is why institutional diversification accelerates during this phase. Large asset managers do not wait for perfect clarity. They act when uncertainty becomes asymmetrically dangerous. When upside depends on continued stability, but downside grows nonlinear, reducing exposure becomes rational. This does not require pessimism. It requires prudence. Notice the assets favored during this transition. Infrastructure tied to essential services, energy systems with pricing power, resources that exist outside financial abstractions, jurisdictions with stable rule of law traditions. These allocations are not bets on collapse. They are insurance against disorder. Individuals often misinterpret this as loss of confidence in the future. It is the opposite. It is confidence that the future will be different from the past. The mistake is assuming that adaptation is disloyal or alarmist. History suggests it is simply realistic. Late-stage policy environments reward flexibility, not conviction. They reward optionality, not leverage. They reward preparation, not prediction. This is the uncomfortable truth of transitions. There is no single moment where everything changes. There is a period where choices gradually disappear. By the time outcomes are obvious, positioning is fixed. We are approaching that boundary. The system is still functioning, markets still clear, institutions still operate, but the margin for error is thinner than it appears. In the final section, we'll look at how these transitions typically resolve, what survives them, and why those who navigate them successfully focus less on forecasting and more on adaptability. The end of one era does not mean the end of opportunity, but it does mean the rules change. Every major financial transition eventually resolves, not with a single dramatic collapse, but with a reordering. Systems adapt, power redistributes, new centers emerge, old assumptions fade. What feels like an ending from the inside is often just a shift in structure. History makes this clear. Spain did not vanish after its defaults. The Dutch Republic did not disappear after losing financial dominance. Britain did not cease to exist after the pound lost reserve status. Life continued, markets adjusted, new opportunities formed, but the cost of the transition was not evenly distributed. Those who assumed continuity paid the price. Those who adapted early preserved optionality. This is the most important lesson of every reserve currency transition. Survival does not belong to the strongest, the loudest, or the most confident. It belongs to the most flexible. What we are witnessing today is not a judgment on America's future. It is a reflection of arithmetic. Debt, demographics, and incentives shape outcomes regardless of national identity. Exceptionalism delays recognition. It does not cancel constraints. That is why institutional behavior matters so much. When asset managers with trillions under management reduce concentration, they are not predicting catastrophe. They are acknowledging that the distribution of outcomes has changed. When they increase exposure to real assets, multiple jurisdictions, and non-correlated systems, they are not abandoning growth. They are protecting against fragility. This distinction is critical. The most damaging response to structural change is denial. The second most damaging is panic. Between those extremes lies preparation. Preparation does not require certainty, it requires humility. It means recognizing that the rules that governed the last 40 years may not govern the next 20. It means understanding that stability can erode quietly before it breaks visibly. It means accepting that diversification is no longer optional when systems become less forgiving. For individuals, this does not mean radical action. It does not mean abandoning one country or betting on collapse. It means reducing single-point dependency. Financial resilience is built the same way institutional resilience is built, by spreading exposure, by favoring flexibility over leverage, by prioritizing liquidity when optionality matters most. Assets that survive transitions share common traits. They are difficult to debase. They generate value independent of financial engineering. They remain useful across regimes. Historically, these include real assets, productive skills, and trusted relationships. Skills matter more than portfolios during transitions. Knowledge compounds even when currencies don't. Relationships create opportunity when systems reconfigure. This is why the most resilient individuals in every historical transition were not necessarily the wealthiest. They were the most adaptable. They understood the pattern. The pattern does not promise collapse on a date. It promises change over a window. It does not require belief. It operates whether acknowledged or not. We are now deep enough into this cycle that ignoring it carries risk, but early enough that response remains possible. That window does not stay open forever. Eventually, the system resolves its imbalance, sometimes through inflation, sometimes through restructuring, sometimes through prolonged stagnation, often through a combination. When that resolution arrives, it feels sudden to those who weren't watching. To To those who were, it feels inevitable. The purpose of understanding this cycle is not fear. It is clarity. Clarity removes emotion from decision-making. It replaces reaction with positioning. It allows you to separate headlines from structure, noise from signal. That is the advantage institutions seek when they move early. You don't need perfect foresight to benefit from this understanding. You only need to stop assuming permanence. No financial system lasts forever. No reserve currency holds indefinitely. That reality has repeated for 500 years without exception. The United States is not immune to history. It is participating in it. What happens next will not look like a movie. It will look like a series of adjustments that favor those prepared for change. The people who navigate these transitions successfully are not the ones who guess the exact outcome. They are the ones who respect the range of outcomes. They build resilience rather than certainty. They understand that when capital moves quietly, it is not running away, it is repositioning. And repositioning is not a crisis response. It is a strategic one. The information is already available. The data is public. The behavior is observable. The pattern is consistent. The choice is whether to pay attention. History does not repeat because people fail to act. It repeats because people assume this time is different. It never is. Those who recognize the cycle early do not escape transition. They navigate it. And in every era, those are the people who emerge on the other side with options intact. That is what this moment offers. Not certainty, not fear, but the opportunity to respond while response is still possible. The system is changing. Capital has noticed. The question is whether you will.